Hello, everybody. Welcome. We'll just spend a minute just waiting for everyone to come through. Today, there's a lot of registrations, so a lot of people joining us today. Thanks so much for making the time to come and listen. Hopefully, we should get through this in about 45 minutes, but I'll just give it a minute so everyone can pile in. Okay, well, we might get started then. Hello and welcome, everybody. This is Superheroes Investment Trends of 2022 webinar. We're so glad so many of you have joined us on this balmy Tuesday here in Sydney or wherever you are around the country. My name is Jack. I'm the head of content here at Superhero. It's basically my job to help educate our users and keep you all up to date with everything going on in the market. And today I'm lucky to be joined by Kanish from ETF Securities, who has put together today's slides and webinar. Welcome, Kanish.
Jack, thanks for having me.
Of course. A lot of registrations. Everyone's very excited. We also have Rachel, my colleague, just in the background. She'll be managing the online chat. So if you do have any general sort of comments as we go, feel free to throw those into the chat. And we'll also, of course, have a Q&A at the end of this. So Kanish can answer any market trend questions you might have. But as I said, there are a lot of registrations. People are very keen to get into this, so let's just jump right in if you want to take us away.
Cheers. So look, the presentation today and then the topic is investing trends for 2022. It's very much an interesting topic at the moment, I guess, in time in investment markets, given what's happening from a macro perspective, what's happening from a geopolitical perspective, with potential tensions now arising in Ukraine, Russia, and Europe and the US. To speaking with a lot of clients, and just so people are aware from an ETF security standpoint, we're an issuer of ETFs. Some of the ETFs you guys may know of is things like ACDC, gold. Recently launched some thematic ETFs last year, but we speak to a lot of private wealth, a lot of institutional clients, and they're in this sort of phase at the moment in terms of where do we allocate to market. So hopefully in today's session, we'll try and just talk through things that you should consider from an investment perspective, some ideas from a trading perspective and investment ideas that you could potentially take to pivot your portfolio from a tactical and a strategic point of view, given the considerations for 2022. So just have up on our screen, obviously, the disclaimer, which my compliance team likes me to show and spend a few seconds on at the moment. But obviously, just on this, any information provided today is general in nature. We do recommend you speak to an investment professional, also read through the product disclosure statements, the TMDs of any products that are discussed today as well. So I guess kicking off, from 2021. So there's great. We can talk about what happened in what to look out for in 2022, but we should look back first. And for the second year running, we really saw that the pandemic in itself was key, from a health and an economic concern, and we saw that there was a lot of hope in 2021 that brought, the idea that potentially the pandemic, the COVID-19 pandemic, would be behind us. However, we saw that sort of acceleration in virus cases earlier on, and particular countries like India, for example, and some of the emerging nations, Brazil, in early 2021, that really got impacted by COVID-19, that sort of their second wave. The benefit, or I guess what we did see, was vaccines, and vaccine rollout started in late 2020, and we saw really high vaccination rates really continue, especially in Europe, the US. Australia, obviously, we saw a big pickup towards the back end of 2021. Obviously, certain states were behind others, but we really did see vaccine rates in the back end of 2021 really pick up as concern on Omicron in particular started to raise its head. And I think that's the other thing, is that the pandemic wasn't behind us in 2021. We saw it sort of come back to and fro. So it was still around. In 2021, we also saw supply chain disruptions. Now, we'll talk about supply chain disruptions and what impact that's having. But when you consider why we're having supply chain disruptions at the moment, part of the reason was in 2020 from increased demand. Then you saw demand continuing as stimulus packages were continually rolled out across the world. So people had more money to spend. People were not going on holiday, they had more savings and they were buying more. But you also had, at the same time, borders being shut down, transportation being impacted still by COVID-19. So you saw impact on supply chains and the ability to transport goods and services. You saw factories being shut down, whether it's through the second wave of COVID-19, whether it's through Omicron. You saw restrictions being introduced around the world. So you saw some manufacturing industries impacted, and that again has a flow-on effect on the supply chain disruption. Interest rates, we also saw continually being touted at low rates, and there wasn't any increases last year. So what you actually saw for the bulk of 2021 was markets did quite well. And you can see there that on the chart, the MSCI All Country World Indices, that's essentially your global shares, did nearly, I think it was about 27% for the year. You saw the ASX 200, for example, just did under 20% as well for the year. So that concern on interest rates, really that low interest rate environment continued into 2021. There was obviously concerns or discussions around what would happen with interest rates. And, there was a rising real interest rate environment at the time, but that didn't impact the equity markets as much in the early to first 3 quarters of the year. What we saw in the back end, obviously, of 2021 was concerns on inflation. And we'll talk about inflation in a few slides. We'll talk about what influences inflation and why we're seeing inflation at the moment. But you obviously saw inflation start to rear its head, and now that had an impact on equity markets. So you started to see definitely a pullback from about that October or November, December period in particular, and that's continued into 2022 as well. Now, that then leads into looking at other asset classes, things like gold. And what we saw with gold, obviously, was gold is a really good hedge to inflation. It's a really good hedge to equity market volatility, and it's a really good hedge also to geopolitical risk. And we actually saw gold, stand up. It was fairly neutral, and that's in Aussie dollar terms, that gold price there. But you can see from that perspective that gold really, it obviously didn't shoot the lights out like equity markets did, but it did what it was supposed to do in terms of its place in a portfolio. And then finally, there was a lot of discussion last year on cryptocurrencies and Bitcoin. And here in Australia, specific to the Australian ETF market, we've actually seen a lot of talk, and ETF Securities, are part of that discussion, that conversation, and wanting to launch Australia's first crypto ETFs. But Bitcoin hit record highs last year. From an Australian dollar perspective, it tipped nearly $91,000 in terms of its price. Now it's trading well below that at the moment. And, looking at over a 6-month period, it's currently up, I think it's down nearly 6% on a 6-month basis at the moment. But what we did see last year was a lot of discussion, a lot of talk around Bitcoin and cryptocurrencies. Are they the safe haven asset? Are they the hedge to inflation? Are they the hedge to equity market volatility? Do they replace gold? What I can say, at the moment is the jury's still out around whether Bitcoin can replace gold as a hedge to some of those areas, because recently in the past few weeks, we've actually seen Bitcoin being very highly correlated to equity markets as equity markets have come off. So still some discussion, some thoughts, some views, I think, still on Bitcoin and where its place is in the future. But safe to say it is going to stick around, and we will have cryptocurrency ETFs in Australia, hopefully sooner rather than later.
That's right. Well, it's a great place to jump off, Kanish, as well, because I think even this year does feel so different to last year and the last 2 years, where it was all about tech, it was all about growth, all of these more, things like Bitcoin, cryptocurrencies really shooting the lights out. And already this year, gold is up in the last few days, particularly around Ukraine-Russia tensions. Bitcoin's down, but it does feel very different as we head into 2022. I think this is what your next slide speaks to, but what should we keep in mind for the next 12 months?
Well, I guess the next 12 months, and I'm going to preface this by saying I don't have a crystal ball. So it's really hard. I'm not going to sit there and say the markets are going to go up by X% or they're going to go down by X%. At the end of the day, investors need to be diversified across different asset classes. And that's the best way to build your portfolios. You need to reassess your risk profiles and align your investments to your views and values. And so take this then with one of the inputs in terms of what you are trying to consider for 2022. And for me, I was sort of looking at it and going, well, COVID-19 obviously is still there. It's still relevant for all of us. There is a lot of hope that we are seeing, and we're at the back end of the pandemic. And there's a lot of hope that COVID-19 will become more endemic than being pandemic, in the sense of it is then just now treated as we may treat a normal flu, with the vaccine rates being quite high across the world, and continual treatments being developed, etc. But I think there's still question marks around how governments, how countries will respond should there be further new strains and further new waves as well, because obviously there is pressure that's placed on the hospital system. Something else to consider, and we'll talk about this in a minute, is growth. I think growth at the moment for the future, it's going to be strong, but it's not going to be stable. And I'll touch on that shortly. I touched on supply chains already and disruption, and that's going to remain. And we'll talk about what impact and potentially which countries are going to be impacted more than others. Inflation and interest rates. So there's sort of two other factors I think everyone's talking about at the moment. And, I put these slides together last week, and probably I should have put into this slide as well, geopolitical at the moment, giving it so front of mind. Now, there's obviously hope that those tensions in Europe and Eastern Europe dissipate, and they don't come to fore in terms of what the worst outcome could be. So, but that is something that also people should consider. But I'll touch on that in a few slides as well, especially when we talk about gold as well. But looking at global growth. So this is just taken from the IMF. This is data as at the end of last year. Now, in 2021, the global growth for the world, it's estimated was 5.9%. Now, that is a pretty strong rebound from 2020. What does it look like in the future, though? So you can see there that from a world perspective, from a global point of view, it's still quite strong at 4.4 for 2022. And its projections is slightly down at being 3.8 in 2023. Now, that is pretty consistent when you look individually or at certain regions, whether it's the US, for example, whether it's sort of the Euro area. So that includes, Germany, Italy, Spain, etc. Australia is an interesting outlier in this space, in the sense of it has pretty consistent projections for 2022 and 2023. Geographically, we're somewhat protected, but even our economy very much looks to be, quite consistent in its performance. But then you look at something like, the emerging markets and China. Now, China's really strong rebound in 2021, and India as well. So India is a bit of an outlier when you look at country basis in terms of across the world. So I was looking at this both across developed and emerging markets. It had one of the strongest economic growth figures projections, both for 2022 and 2023. Now, obviously, the part around all of this, especially in the early part of 2022, the impacts are going to be what we're going to be talking about now, which is supply chains. We mentioned COVID-19. In China, there is also that disruption in the housing sector that has served as a bit of a prelude, I guess, that we consider to a broader slowdown. And a thing to consider just with China is their potential strict sort of zero COVID strategy. Now, here in Australia, with that idea of sort of zero COVID strategy has been sort of put aside by most state governments and also by the federal government in how we treat the virus. But China still is adopting that approach. So that potentially, as I said earlier, if we saw new strains, could impact the Chinese economic growth outlook at the moment. And just furthermore on India, I think one of the things there is there's some really strong revisions on India's growth, and part of that is on expected real strong improvements expected in the credit growth market. And therefore, subsequently, what you generally see is if you've got really strong credit growth, you then see stronger investments and consumptions by the population. And that obviously is going to assist in that financial sector. So a lot of people may not realize, but the Indian equity market actually did very well last year. Even when you look at other emerging markets, in China, had some pretty poor performance last year. But India, again, from an emerging market perspective, was a bit of an outlier. And obviously, from an ETF standpoint, ETF Securities has an Indian equity ETF, NDIA, which looks at the 50 largest companies in India, very much focused also with a strong overweight to financials there. So that's looking at sort of the economic growth side. But then I've talked about it and, supply chains. And if you're, the other day, it was funny, I was wanting to look at, whether it's TVs, beds, cars, smartphones, PlayStation 5s, for example. The idea of supply chain disruption, whether it's because of semiconductors, but it's really having a big impact on the global consumption of goods. Now, the chart on the left is a really interesting chart because it looks at what impact is happening on the global trade growth. And you can see there, is it demand shock? Is it supply shock? Is it logistic shock? And what we're actually seeing is that the production shortfalls explain about 75% of the current contraction of global volume of trade. So while logistics, like the logistical bottlenecks, are explaining the rest. The other thing that we need to consider is, the impact I've mentioned on the virus that it's having, but how will dynamics eventually improve over the year? So yes, we're going to see, and we will see, continued supply chain issues. That's, I think for the foreseeable future, in the short term, that's going to continue. But later on this year, there is a hope and there is an outlook that there's some of those dynamics will start to improve. So what do I mean by that? So we may see, obviously, from a policymaker perspective, they're implementing policies. Governments are trying to future-proof their logistical supply chain issues that they currently experience or have experienced. We're seeing greater stabilization as people and countries are coming out of restrictions. We're also seeing increased usage of new technologies, whether it's automation, robotics, artificial intelligence, to assist in that manufacturing and the logistical automation process. So all of these things are coming together. Now, there is a hope that in terms of looking at that rebalancing of services rather than goods as well. So you obviously have this really big stimulus packages that have occurred in 2019, 2020, 2021. You've seen inflation start to impact prices on certain goods as well. So that's going to impact demand on some of these goods, which again will help in stabilizing some of the supply chain issues that we currently have. But if people have read the news overnight, or you may have seen even over the last few weeks, the US government, but even European governments have earmarked potential concerns on semiconductors, which will have an impact on that electrical and electronic side, and even automobiles as well. The chart on the right is interesting from the perspective of just looking at it at a country or a region perspective. So you can see there that the impact in terms of disruption that we have is mainly felt in developed markets. It's not necessarily felt within China or emerging markets. Now, part of that reason could be the types of demand of goods that are being consumed and demanded, the potential logistical moving of those goods when they're produced and to getting them to the end consumer as well. Obviously, a lot of goods and a lot of electronic goods are produced within emerging markets or within China. But the other thing I think to consider there, and just in terms of a potential forecast, I talked about China's zero COVID strategy. If that continues, if we see new waves, that potentially could elongate the supply chain disruptions that we may have, given the reliance that currently the world has on China for some of the manufacturing of a lot of its goods at the moment. Talking about inflation, I think, it's definitely a topic of conversation. I really, found that the chart on the left was very useful to try and explain to people, though, why we're currently seeing this big rise in inflation. We look at it and, inflation at the moment in the US is hitting at around that 7.5% right now. What's impacting that, though? And that will hopefully assist people in trying to understand, well, is inflation transitory, which is a word that, is constantly being used. I think we know that the Fed has tried to steer clear of that word from late last year. The RBA, the Reserve Bank of Australia, is still wanting to use the word transitory at the moment. But where does inflation sit? Will it continue to grow? So the chart on the left just shows you the inputs or the price pressures, so the drivers of inflation in 2021. Now, what you can see there when we talk about the US is we saw a big input on the inflation pressures was because of energy. And the next slide will actually show you how much, because motor fuel, oil has increased nearly 50 and 41% respectively. You can see there that in Europe, a large part of their inflation pressures is because of that energy and also food. In the US, you've got some other inflationary pressures. So you've also got wage growth. So here in Australia, we've yet to see wage growth impacting and influencing inflation, but we are seeing that in the US. You've also got the impact that you have on importing goods as well. The logistical supply chain disruptions that you're seeing. So that's the other that you see in the US as well. Now, on the right, we've got the inflation forecast. Now, this is from Market and Allianz Research. And you can see there that this is average, by the way. So you'll obviously note that the US hit 7% year end for 2021 and are currently at 7.5%. So people may be looking at that 4.7 and 4.4 figure, and questioning, have I put my numbers down correctly? But these are average inflation over the 12-month period. So there is an expectation that if you start to see some dissipation of the supply chain issues, you start to see, some normalization on fossil fuel prices, and hopefully also some normalization on wage growth as well. You may see some of that inflation, pressure start to come down. Obviously, when these forecasts were done, they didn't take into account potential geopolitical risks and tension within Eastern Europe and the impact that that may have on oil. And so that is just, again, something to consider. We talked about not being able to look into a crystal ball, and this is one of those scenarios here. The other thing, I guess, and that link between supply chain and inflation, I really like the chart on the left because it shows that supply disruptions shaved off about 0.5% of global GDP growth in 2021, but it added about 1% to core global inflation. So you can just see that the impact that some of those supply chain disruptions have had. Now, if they start to move away, and we talk about inflation, is it going to be here for long? What should I consider? Should I be, buying all my goods now at the prices that they are? Should I be locking in prices? Where should I be investing? I think a key part of this is inflation. When you look at a lot of other, experts and forecasts, there is some expectation that inflation will continue to have pressures over the next 12 to 18 months, but it's not necessarily seen as very much a long-term issue. It should start to come down as you start to see some of those drivers start to move away. Now, the chart on the right I found a very interesting chart, just because from the perspective of what is, we talked about individually, if I look back here, some of those inputs on the price pressures, and you can see there the year-on-year price changes. This is specific to the US, and this is from the Bureau of Labor Statistics, and this is as at the end of December 2021. And you can see there what has actually, being influenced by some of those price pressures and, oil, energy we talked about. Used cars and trucks, that's interesting because that actually is an offshoot of the fact that there are not enough new cars being produced or being delivered. So used cars have become more expensive. And we've seen that here in Australia as well. Obviously, some basic food staples, things like beef and veal and meat or eggs, have also been impacted and seen some increased price changes as well.
It's really fascinating there, Kanish, to see those links, right? Like they all make up a piece of the puzzle between, you know, supply chains being disrupted, semiconductor shortages, inflation, all of these things kind of fit together. Oil price hitting a 7-year high. And yeah, just fascinating to see how it plays out, but how, you know, there is such variability between each of those.
And I think it's important, yeah, to take into account that when you talk about inflation, inflation is a basket of goods in terms of prices, in terms of how inflation is calculated. The other thing to consider there is how do reserve banks, how do Federal Reserves, central banks around the world, how do they respond? And so to control inflation, central banks have one tool available to them, and that is interest rates. Now, interest rates have been at record lows around the world, but if inflation is here and it's increasing, and whether it's because of oil, whether it's because of, you know, some of these supply chain disruptions, it is, you know, believed to be something that will hopefully, you know, start to move away. You can see here, you know, the 2023 forecast in the US inflation to be averaging about 2%. In Eurozone, it's about 2%, you know, off those highs of what we're seeing at the moment. Central banks will be using interest rates to try and control inflation getting out of hand, because you don't want to be in that situation. So we will, I think, see, obviously forecasted, there is some expectation on the Federal Reserve raising rates. How aggressively they raise rates, though, will be how inflation responds. And I think that's the key point on all of this. And obviously we talked about some of those inputs, the geopolitical tension, not referenced here, not included. So that will be something that investors should just be mindful of when they look at this.
Yeah, it certainly seems like it's going to be the story of 2022, doesn't it?
I think noise. I think if you were to sum up what is 2022 going to be like, I think it's going to be noise. Really, it's going to be noise from inflation, noise from interest rates, noise from, you know, geopolitical tensions. That's really the word that I would use to sum up 2022. So for investors, it could be a bit of a bumpy ride, but there are still places to look at when you're looking at where do I put, you know, where do I invest? And so that's probably what we're coming to here, which is, you know, different trade ideas or investment strategies that investors should consider. Now, some of these may be seen as tactical, but, you know, there is some fundamentally strong long-term strategy behind all of the ideas that I'm going to be talking about over the next sort of 10, 20 minutes. So what I'm looking at here is value. If we see, you know, when we talk about interest rates, the idea that if interest rates rise, they impact discount rates, which is a number used to value companies' profits, and that also rises. So that discount rate rises. So basically, to cut a long story short, if the higher the discount rate, the more $1 today is worth more than $1 tomorrow. So my dollar today is worth more than tomorrow's dollar. Now, if higher discount rates, you know, if they go higher, then the more a company's share price should reflect that the dollars that they earn today, rather than the dollars that they may earn tomorrow. So we talk about growth companies. When a low interest rate environment, basically the dollar tomorrow is potentially worth more than the dollar today. And so what you see with a lot of growth companies are companies that are investing a lot of their capital for future growth. And this obviously has occurred in certain sectors like biotech, where we saw a really strong pullback in that rising rate environment or expected rising rate environment, really strong underperformance. What you do then see, though, that if you're in a rising rate environment and growth stocks, or, you know, and that there's a big discussion of what is a growth stock, because if you would ask me personally, I don't believe though some of the FANGs should be classified as growth stocks. You know, an Apple and a Microsoft to me is not a growth stock and shouldn't be seen in the same way. But, you know, that's probably another discussion for another time. But if you have higher interest rates, then there is this tilt that investors look at, and they look at value. So what we're looking at here is on the left is where can you find value? Is there value in equities? And yes, generally you do have value in certain sectors and in certain companies. And it's just a point of, example where you can see the table on the right, which is the sector performance breakdown in US dollar terms of the S&P 500, which is essentially the main benchmark for the US. We can see there that over 1 month, 3 months, and sectors like consumer, energy has done exceptionally well. We can see where have we seen some underperformance, and it's in things like when we look at technology, when we look at communication services. Traditionally, by the way, communication services would include companies like Google and Facebook. Technology, obviously, pretty straightforward, includes companies like Apple and Microsoft. But you can see there that there is some pullback that we are seeing in a rising rate environment on certain companies and certain sectors. So if there's this tilt to value, what can investors do? Well, there's a strategy that we have. It's a strategy focused on the US equity market. It's what you may call smart beta. It's a low volatility, high yield strategy, and I'll talk about that in a minute. But we're also looking at Europe as well. And if you look at the left there, you can see a chart that I've just put up, which is Europe's global earnings revisions versus the world. And what we can see is that we're seeing increased upward trend on earning revisions from Europe at the moment versus the rest of the world. Now, Europe's been one of those areas of investment that a lot of Australians don't invest in. Part of the reason is they either say, well, I've got that exposure through my global, ETF or global manager. Part of the reason is they simply ignore it because the US and companies within the US, they're the most talked about. They're the ones that's seen and are the ones that people are most aware of.
The shiniest.
I think they're the shiniest, exactly. People may not know, but in Europe you have some very big companies as well. Like Louis Vuitton, Moet Hennessy, so LVMH. You have ASML. You have SAP, SAP, Sanofi from a medical perspective. So you have some really strong companies in Europe as well. But the other thing people don't consider within Europe, or they have taken into consideration, is Brexit, and that's been a reason why people have sort of steered clear from Europe for about 5-10 years. And when you think about it, in the past 5 years, in the environment that we've had from a market perspective, with growth being growth stocks and a lot of those US names doing so well, people maybe rightly have said, I don't want to look at Europe. But two ideas that we've looked at is, for an ability for an investor to look at value, is one, don't discount the US. And so this is a strategy that we launched nearly 6-7 years ago now. The code is ZYUS. So it is it's a 50 stock basket portfolio. So it's 50 stocks from the US made up from the S&P 500. So it's actually coming from the S&P 500. But it looks at the 50 highest yielding, least volatile stocks from the S&P 500. Now, what was interesting about this particular ETF, and if anyone has any questions, we do have some slides in the appendix I can run you through, just showing you some of the breakdowns, etc. But it's got a tilt towards value sectors. So whether that be energy, utilities, REITs, consumer staples, it's got a tilt towards value. Now, because of that volatility screen, it actually is a defensive play on the US. So when you have equity market volatility, this particular index strategy that we track for within this ETF actually done considerably well versus the S&P 500, even though it makes up 50 stocks from that. And I think the other key point, it has high yield in its name. Now, that figure there, that's a product yield, but the historical yield on the index has been upwards of about 4.2%. Now, the historical yield on the S&P 500 ranges between 1.8 to 2%. Now, that's over a 20-year history as well. So again, we get a lot of questions. How can you get income from other markets? And this is an area where people can consider, not only for the yield, but for the value tilts as well. And then the other product that sort of idea that we had from a value perspective was EUROSTOXX 50. And this is our ESTX ETF. So it's very simple in its makeup. Essentially, it's the 50 largest blue chip companies from the Eurozone. So it doesn't include the UK. And now that's really important because it is only focusing on Eurozone countries. And so whether that's Germany, Spain, Italy, France, Netherlands, etc. But it is an easy way for people to access Europe. Now, within this particular exposure, you have a lot of exposure to financials, which obviously in an inflationary environment, in an environment where interest rates are rising, in an environment where we're tilting more towards value, banks, financials, looking at it from the perspective of energy, they're areas that will benefit. You also have within this particular ETF some really strong names, and you mentioned, the shiniest of names, but companies like L'Oreal, I mentioned Louis Vuitton, companies like ASML, the largest, provider or the only provider of EUV lithography machines, which is they've got a monopoly on this. They've got, they produce the technology that essentially makes semiconductor chips. And ASML is the largest holding within this ETF. So, don't discount other regions when looking at value. The other thing that investors should consider, and we talked about, earnings, we talked about interest rates rising potentially and how that may impact growth stocks. But what people should consider is, are some of the thematics growth? Do they have really high valuations? And people always look at PEs from a valuation perspective. And so what I wanted to show you here was, this is forecasts that we've run using Bloomberg's earnings per share data, and it's calculation based on a blended model. So it is very indicative, and that's, full disclaimer there. But what we're trying to look at is, what is the basic estimated forward PE ratios for some of the thematic ETFs. And it was interesting to look at this because whenever I show this data to people, they sort of ask me, well, I just would have thought, thematics like semiconductors or a thematic like battery technology through our AC/DC ETF would have had very high PEs. But you can see here that the PE, forward PE, or the PE as of, for end of 2022 is under 15, where the S&P 500 is sitting at about 22 times, or the NASDAQ 100 index is sitting at about 29 times. So people ask the question, well, why is that the case? And you look at semiconductors as well, relative PE is sitting on par with this S&P 500, but starting to come down when you look at it over 2, 3, and 4 years. Now, the reason that is if I looked at AC/DC, that is partly because it's not just made up of tech companies. Yes, it's got battery technology in its name. It is the ETFS Battery Tech and Lithium ETF, but a big portion of this ETF is lithium miners. Now, they're going to have, they're, in theory, energy resources, they're a value area, and they're that reopening trade. You also have a lot of car companies within this ETF, whether it's, yes, Tesla's there, but Tesla, to be honest, is probably the one with the highest PE, but it's actually starting to turn a profit, and it's in a very strong position to capture the EV market. You have in this space Renault, Daimler, BMW, Nissan. So some very strong car companies, again, not companies that you generally associate with high PE. So when people think of thematics, they think of growth, they think high valuations, and they think, well, it's going to be impacted in this current rising rate environment. We've actually seen AC/DC as a thematic ETF outperform, some of those growth broad benchmarks, such as the NASDAQ 100. It's outperformed the S&P 500 market, and it's done some very strong returns, even in the volatility that we've had. So again, don't discount thematics, because you may be caught up in that stereotype or that, that view that growth thematics have high PEs. Not necessarily the case.
Which is amazing to see, considering, the sort of projections for the EV market, for lithium, for those sorts of drivers. They've clearly had a very good run up in the last few years, but to see that valuation is actually quite surprising.
Well, it's interesting because you talk about the growth of EV. So in Australia, in 2021, we had 1.95% of new cars sold were EVs. Now that's the highest it's ever reached. And so it's on the upward trend. It's still low, and I think there's a lot of work still to be done by governments. We saw 6.6 million electric vehicles sold in 2021. Now that is 3 times the number of electric vehicles sold in 2019. So in 2019, you said 2.2 million. You had 6.6 million being sold in 2021 alone. And a bulk of those, actually nearly half, was coming out of China. So you're seeing some of the emerging markets. You know, we talk about thematics and, you know, why people should consider thematics. It's a long-term trend. It's going to have some volatile periods. It's going to go up and down. You know, hydrogen is one of those areas, you know, you and I were speaking about, Jack, just before we jumped on, but that's a view there that, you know, it's going to be impacted with volatility. It's going to have some down times, but over the long term, this is a technology that's going to be there for the future. So people need to look at these thematics with a long-term lens, 3, 5, 10 years. And ACDC had nearly $400 million invested in it last year. The ETF itself is now over $500 million. So I think it's about 520, 530 million in size. So it really shows you how strongly aligned Australian investors are at the moment to some of these thematics at the moment. And just talking about supply chains, and, you know, we talked about disruptions. I found this really interesting. So this was some research done in 2021. So roughly around 44% of organizations from different industries from around the world revealed that they expect that robotic process automation to have a big impact on, you know, supply chains by 2023. Now, if you think about that integration that we get now with robotic processes, so companies like Keyence, for example, or Daifuku, or Yasukawa, which is Japanese, they do logistical automation. Or even Ocado, they do grocery logistical automation. It's a UK company that have a really strong tie-up with Coles here in Australia. You'll actually see some really strong benefits and potential, hopefully, a turnaround in that supply chain disruptions through the use of robotics, automation, and artificial intelligence. So when people look at thematics like Robo, which is our robotics and automation ETF, they actually would question, oh, so how is this going to be impacted? Is it going to be actually negative? Are people going to be able to sell, you know, robots? And, you know, is that technology going to be lagging because of the supply chain disruption? Well, no, they're the solution. And that's really interesting to see. And obviously chips and semiconductor chips, you know, just that idea of needing chips around the world and in everything that we do, there is a stronger importance. And we saw that, as I mentioned, in Europe overnight. They're pledging, I think it's $43 billion to trying to build and future-proof domestic semiconductor industries. And so there's a really strong need at the moment around, you know, the idea of what is the value of a semiconductor. And to me, semiconductors are the oil of the future, if you think about it. You know, if you're going to have an electric vehicle, you don't need petrol. You need electricity, you need batteries, lithium, and you need semiconductor chips to help all of that work together. So really, it's integral for our future. And obviously, we have an ETF we launched late last year looking at just the semiconductor industry. So it has the 30 largest companies from that industry there around the world: Taiwan, Korea, the US, Europe, etc.
And I really like that slide, right? Like, as we were saying, you know, these are obviously big challenges, you know, in terms of things like supply chain, but, you know, for investors, there's also, I suppose, an opportunity there as well. These things aren't entirely negative. There are losers, but there are also with that winners.
Yeah, exactly right. And so there are ways in which you can actually invest and position for that disruption. So, you know, the semi one is one strategy, and then obviously the Robo ETF we talked about. So there are, you know, a few ETFs looking at this thematic on robotics and automation and artificial intelligence. The Robo ETF, from our point of view, obviously we use an index run by a team called Robo Global. They are, you know, these guys basically apply an active lens. So you think about active funds management, you know, you have portfolio managers, researchers, analysts looking at companies. They apply an active lens in building an index. So we track an index that is rebalanced every quarter. So the names don't change in between the quarters, but the companies in this portfolio are crucial to the megatrend. They're not just, you know, we've got companies like John Deere, and people look at us and say, well, why do you have a tractor company in an ETF looking at robotics and automation and artificial intelligence? And the reason being is, you know, John Deere, majority of their tractors use autonomous driving technology and sensing software. So they're one of the leaders. They actually do a lot of acquisition in this particular space. And so some of the guys that are behind that Robo Global team are, Rafaela DeAndrea. He's the founder of what is now called Amazon Robotics. So, he very much is, crucial in that process in providing support for this ETF here as well. And finally, in terms of inflation and how you can tackle inflation, but also volatility, and I'd probably add to this geopolitical tension as well. We've seen in the past historically that gold has been a really good insurance in portfolios. And people ask us, and in 2020, we saw a large swathe of investors start to adopt gold because of the volatility that we saw in the first half of 2020 because of the pandemic starting to come around. In 2021, as that equity market volatility went away and it was all about growth, people started to move away from gold. People often ask us, well, why should I invest in gold? It's a shiny asset that doesn't give me any income. And the response that we have is, well, it's insurance for your portfolio. So if you go out and you get car insurance, you get home insurance for a fire, you're not wanting to use that insurance, by the way. That's for the rainy day. And in the same way we view this, in the gold, it's there as a hedge, and it's been a hedge historically to inflation. And you can see there, the real return and the nominal return that you actually see from gold in a low inflation environment and in a high inflation environment. And you also know, and we've seen it, and it's been proven in the past few weeks, what gold has done when we've had equity market volatility, rising inflation expectations, and even overnight with increased geopolitical tensions, we've seen, again, gold start to perform in the way in which it's supposed to. It's there as a hedge. It's a defensive alternative. It's a smaller allocation within your portfolio. And so, for us, we have GOLD, stands for gold, obviously, but it's backed by physical gold. So an investor that wants gold, what can they do? Well, they can easily go out and buy gold, in a jewelry store. They can buy gold from a precious metals dealer, but they have to pay exorbitant fees for vaulting, for storage, for insurance. They may not get the right spot price for gold. So we made it really easy. We were, this is the world's first physical gold product launched back in 2003. So we have nearly $2.5 billion in this fund, and that equates to 27 tons of actual gold that's sitting in a vault that's backing this ETF. So for every dollar in this ETF, it's backed by $1 worth of gold, and it can be redeemed for the metal as well. But for us, it's something that it's a boring asset, and people often look at it and go, no, it's not for me because it doesn't do anything. But I would say it's a really good defensive alternative especially in the current climate. So if you're thinking about inflation and it's going to rise, if you're thinking about more volatility on the cards, having some gold in the portfolio may not go astray in terms of being defensive. And the gold in the vault is also insured. We've just had that question come through as well. And just a final point, I know there are a few questions that have come through, but I guess just in terms of rebalancing, really important when you have these really strong movements in asset classes or in investments. Now, if you had invested at the start of 2020, or not the start, but just as on the lows of after sort of March in 2020, and you maintained that investment and you did not look at it, and you said, well, in March 2020, I want 30% of or 50% of my portfolio to be equities, I want 40% to be bonds, and I want 10% to be alternatives and cash. That may not be the case in June 2021 or December 2021. That allocation of what you originally wanted may have moved. So it's really important that on a periodic basis, you look at your portfolio and you rebalance it. Now, you may turn around and view that portfolio at the time and say, nope, I'm happy with how the portfolio looks. But if you're not, it's really important, the idea of rebalancing, because it can be very risky to forget, and you potentially maybe, swiping away all your returns that you've had by not rebalancing. So sometimes it's good to take some profit off the table. Sometimes it's good to rebalance back and review and reallocate to whatever your views and values are and whatever your risk profile is at that time as well.
Particularly given, I think, the last 2 years where we have had such, enormous growth, but also, growth that has been particularly strong in areas like tech, where, if you're invested in those kinds of areas over the last 2 years, tech could have become a very large percentage of your portfolio.
Yeah, exactly right. And as an ETF issuer, that is something that we want to just make sure we drill in and talk to people and say rebalancing, it's important, diversification, it's important. Also look beyond certain issuers. There are more than one issuer. We've now got from a passive perspective, so people that issuers that just track an index, there are 6 issuers in the market, including ETF securities. There's multiple funds available on different asset classes, different strategies, and so there's over 240 ETFs now available listed on Australian exchanges for investors to look at. And obviously you've got then the offshore aspect, which I know through Superhero's platform you can look at. So there's many more options that people have available to them. But from our perspective, if you ever have any questions around ETFs on its own, any questions on some of the funds that I've talked about, reach out on our website or give us a call on our client services number or an email, or through socials as well. We've got I think those questions come through on India and an ETF focus on the Indian market. And obviously we have an NDIA ETF. It looks at the Nifty 50 index, which is the 50 largest companies from India. And that's weighted by their size. And so, companies like Reliance, for example, and so you've got Reliance Industries, by the way, is one of the largest companies in India. And so that's an ETF there that people can find out on our website.
Yeah, and I'm just looking through the questions now, and we will open it up to the Q&A. And I see there's some questions in the chat, so I'll just run through them kind of as I see them. Kanish, Remus has asked, is the medical sector worth investing in 2022? End of pandemic means people would likely move on from this sector. Obviously, you can't recommend specific things, Kanish, but what are your maybe general sort of top line thoughts on that?
So I think we've got an ETF on biotechnology. It's the ticker is CURE, C-U-R-E. What we have seen in 2021 was a real strong underperformance in that particular sector. Part of it was obviously related to that rising interest rate environment and that impact that has had on really growth stocks, and obviously biotechnology is in the growth sector. We also saw a bit of a pullback in terms of COVID-19 and vaccine push, etc., and sort of investors starting to cash out as well. And you also saw really strong policies starting to come through and potentially impacting the US medical sector. So that particular ETF looks at the US biotech sector. Something to be mindful of though, COVID-19 is but one virus, and so the biotechnology sector is focusing on many different treatments, vaccine developments, other drugs, other medical devices, etc., outside of COVID-19, whether it's to treat and assist in cancer patients, whether it's rheumatoid arthritis. There's a lot that's happening in that particular area, but it is going to be, if you look at biotech, it's more volatile. And so, don't discount, I guess, some of those areas just because of COVID-19. Also consider the fact that there is such an importance now being placed on viruses, vaccine development, treatments, that it's not going to be an area that goes away anytime soon. I think governments around the world are going to be very conscious of being prepared for the next COVID, and hopefully we never have that, but we need to be prepared for that as well.
Exactly right. We have another question from Nikki. She this goes to sort of one of the final slides there. She said, is there a recommended timeline for rebalancing? Every 3 months, for example, 6, 12? Is there sort of a general rule of thumb?
Well, I can't speak for everyone. I think it's dependent upon the number of investments you have in the portfolio. It's dependent upon the outlook and how tactical you also want to be as well. So it really depends. I think sometimes it's not necessarily a case of rebalancing, but it's more a case of periodically reviewing and ensuring that the portfolio still is in line. It may have moved slightly from where you originally set it, but it's still in line broadly with the strategy that you're wanting. So it may not necessarily mean you rebalance it every time. We talk to investment professionals and they have ranges in which they say that their equity basket should be between X to X. And that's fine. And this is, by the way, it's a hypothetical. They may say the Australian equity basket should be between 20 to 30%. And so they've allowed themselves that range. They set it at 30% at the time, and then it may go up or down, or they set it at 25%, for example, and it may move slightly. So, as long as you're periodically reviewing it, I can't say, it should be 6, 12, 3 months, 1 week, maybe daily, maybe weekly, maybe a bit too much, especially if you're long-term. And that's something that, technology, the fact that you've got a smartphone and you can sit there and go, I'm just going to quickly look at my portfolio. It's not necessarily a good thing either if you're investing for the long term, because you're constantly looking at something that you're thinking about for a 10-year plan. And if you're constantly looking at it, you may start to try and get twitchy fingers sort of thing as well.
That's right. We have another question here. What are your thoughts on esports and the outlook for that sector?
I think that whole area, that industry, metaverse, esports, gaming, it's going to be an increasing area. So we have an ETF on FANG. It's a 10-stock concentrated portfolio looking at like the FANG stocks: Facebook, Amazon, Netflix, Google, Apple, Microsoft's in there as well. So I've looked at this a bit deeply, and you can see there that there are some very strong moves at the moment, whether it's from Facebook, potentially, yes, it's had a pretty rough run over the past few weeks, but, they're wanting to pivot into the metaverse, for example, and that is sort of the next evolution of gaming, if I'm really honest. The idea of virtual and augmented reality. You then have the idea of Microsoft buying Activision Blizzard, the third largest gaming company. So definitely an area which I think is only going to continue to grow as we become more accustomed, and the pandemic has taught us to be able to be at home, use the electronic devices, the younger generation that are coming through. I remember when I started, when I was young, playing the Atari or the Nintendo 64 and things like that. I can just see there my son, wanting to take up a new PlayStation 5 and whatnot. So definitely going to be an area that I think will continue to build and grow.
Yeah, and a lot of a big area, a lot of big companies, like you mentioned, are looking at and investing a lot of money in at the moment. We have another question here. I'm wondering about ESG ETFs, and is there anything to consider when looking at these?
Yeah, so with ESG, everyone's got their own personal view or opinion around ESG. How green, dark green, light green, etc. What I would say, we've got the Robo ETF that we have. It has one of the strongest ESG policies in terms of thematics. So the Robo Global team have this policy in place because they want to screen out companies that are being involved in, war crimes or weapons, systems and things like that, especially when you're looking at artificial intelligence, et cetera, or surveillance, for example. So we're very conscious of that within some of our ETFs like Robo. We've got an ETF on hydrogen, for example, that has an ESG screen in place because we don't want fossil fuel companies in there. If we're talking about a clean technology, we want companies that are focused on clean technology. But people need to work out where do they sit on that ESG framework and what is really important to them. Some people may be very strong around this, and therefore they may not have certain ETFs available to them because a lot of ETFs may not suit their requirements. What I can say as a provider is we're still focused very much on bringing out green ETFs and ESG related ETFs because it's only going to be a growing area of the market. And it may become to a day where that particular idea of ESG is just, part and parcel of product development and will be the case, and companies just have to abide by it, which is a hope. The idea of corporate responsibility is just something that you would hope is something that corporates and companies do. But the fact that we have to apply a filter at the moment means that there's still more work to be done. Absolutely.
Well, it is almost bang on 1:30, so I think we will wrap it up there. Thank you to everyone for joining us. It was a really informative hour. Thanks so much, Kanish, for running through all of that. There's a lot of material there, but really great to get a 12-month view of some things to keep our eye on as investors. Things to be conscious of, things that will really be moving the market. And just some considerations to take into the new year. So thanks so much for joining us. As always, Rachel, as Rachel mentioned in the chat, if anyone missed it, everyone who attended or registered for this webinar will get an email with a link to this recording. So you will be able to go back if you missed anything, check check on some of the themes we ran through today. And of course, at Superhero, we're always doing these webinars every few weeks, typically. So stay tuned, and hopefully we can have you join us again and have Kanish come back and run through these. So have a great rest of your day, and we'll see you soon. Thanks, everyone.
Cheers. Thanks.
Cheers. Bye.